with palladium, just to give you an idea of how tight the market is, in the COMEX in New York, they have the NYMEX, there's 10 vaults there. And in all of those vaults in the registered category, which is the metal available to market, there's 18,000 ounces of palladium. And if you look at the Tokyo Commodity Exchange, the TOCOM, they've got 600 ounces of palladium in their vaults.
What?
So yeah, it's
You're making me wish I'd never sold my 1 ounce. Hey friends, thanks for joining us. This interview is brought to you in part by the world's easiest to use VPN, Virtual Shield. Do you even realize how much data about you Facebook and Google have? According to this article from The Guardian, the harvesting of our personal data goes far beyond what many of us could imagine. That's why you owe it to yourself to use one of the fastest virtual private networks in the world, Virtual Shield. Their no-log policy protects users from any data breaches. And this Christmas month, Virtual Shield is offering 35% off all VPN plans and all premium add-ons, including Protection Plus, residential access, monthly maintenance, phone support, and VIP performance plans. And don't forget about IdentiSafe, which allows you the ability to block off your computer microphone and camera access from any unwanted hackers or spies. And again, all Christmas month, Virtual Shield is offering 35% off all VPN plans. You have the right to remain private. Do yourself a favor and get Virtual Shield. The link is below this video.
What they've done is really shut down the loose monetary policy warning system, which is gold, that warns us when they print too much money, when they run too loose a monetary policy. They shut it down and then blew the biggest speculative bubble in history. And that's where we're at now.
Hey friends, it's great to have you back. Thanks for tuning in. Hey, for those of you who still care about physical silver and gold and palladium, we have quite an interview for you, because palladium is telling us a very, very strong story, a very important story. And my guest, David Jensen, is breaking it all down. It's my pleasure to welcome David right now. How are you, David?
I'm well. How are you today, Sean?
I'm good. Thanks for coming on, and thanks for reaching out. You said to me that all hell is breaking loose in the palladium markets right now. I hadn't been following palladium at all this year. I see it's around $1,200, I believe, right now, an ounce. I owned a palladium coin at one point. I remember buying the thing at $200 or $300. This goes back years ago. I think I sold it at $800 or $900 on eBay, and that's about the extent of my experience with palladium. But I know it's a very, very rare metal, and but so is physical silver and physical gold. They're certainly more rare than US dollars, which is why our listeners like to hoard real money, honest money. So let's talk about it, but let's start with the basics. Remind us again, how is metal priced? The Rothschilds used to set the gold price twice a day. How is the metal priced today?
Well, the LBMA, the London Bullion Market Association, that's what those four letters stand for. It was created back in 1987, and it was created by the UK's central bank, by the British central bank, the Bank of England. And prior to that, in 1980, the price of gold peaked out at $850 an ounce. It had run from about $45 in the early 70s to $850 by 1980. And what happened then was that the investors and savers were piling into gold because they could see the inflationary monetary policy, and it really stressed the central banks that they had to raise interest rates ultimately to 9% above the inflation rate. So at that time, inflation was running 10% in the US, and they had to raise interest rates to 19% to pull investors out of gold and back into bonds. 7 years after that, the Bank of England, which works very closely with the US Fed, created the LBMA, and they introduced this concept of unallocated contracts. And what that is that until that point, they were actually trading metal in the markets. That if you were buying and selling metal for at any of any size on these markets, that you had to have you were taking delivery of the metal, and that you were actually offering the metal when you were selling a contract. And that very much changed with the creation of the LBMA, because they had what they called unallocated contracts. And that's really a promissory note. It's that you don't have any metal set aside, but you trade an amount of metal, usually in a 100-ounce amount. And they trade these contracts in the spots and the forward and the futures and options markets. They've got various different derivatives of that. So why that matters is that ultimately you're trading now, you're setting the price of gold and silver, platinum and palladium in London on a daily basis for all of the world's major miners are using that price, the PM fix there, the afternoon fix price, to set their metal price for which they're selling their metal. And also, the world's financial institutions are trading in that market as well. But the problem that you have with an unallocated contract, it's a promissory document. It's promised to deliver metal, and you can make promises without limit. And the London bullion market said as much in 2011. They had what was called their local London liquidity survey. And local London is a referral to the delivery mechanism in London and the securing of metal in London. And they said in that they were trading 10 times the posted volume in daily turnover. And so they've traded upwards of 200 million ounces a day in that market. And there's no way they're actually trading metal. They're not exchanging ownership of metal. They're exchanging promissory notes between these institutions. And that works really, really well. You can set the price, but you have to have metal flowing. And that's where palladium is coming into play now, is that the metal is stopping. It's starting to seize up. I've sent you a chart of the lease rate, and we can see that to lease palladium for a 1 month contract is now 29.4% interest. And that interest, by the way, has to be paid in metal, not in fiat currency.
Wow.
So, when the markets are healthy and when there's lots of stored metal, the metal, the lease rate, will actually be a negative value, because you're actually paying people to lease your metal, to take delivery, to store it, and to insure it. So we've gone from a negative value for this precious metal. Over the last several years, it's gotten tighter and tighter, and now it looks like the physical signal that we can see from the lease rate is that the metal is becoming increasingly unavailable, and I think we're going to head into what's going to be a very disorderly market here in London.
So let me ask you this. Why is this happening to the palladium market, do you think, as opposed to, why aren't we seeing this in the gold or silver market? Yeah. Is it because the palladium market is so tiny? There's such little of the stuff out there?
That's it, Sean, is that it's a small, to give you an idea of the size of the market, the annual consumption in round numbers is about 10 million ounces a year. Russia produces 40% of the world's mine supply. South Africa produces 40% of the world's mine supply. And the CEO of Jensen, in an interview in 2017, and that's one of the world's biggest refiners of precious metals, and he warned, he was basically sending a warning, I think, to the bullion banks about the pricing of palladium. And I just want to read a quote from him. It was published by Reuters, who have taken it down, but it's still findable on CNBC. And he said, over the last 10 years, the market has been kept adequately supplied by a very large movement of palladium out of existing stocks, so like stockpiles above ground, as is evidenced by trading statistics suggesting net withdrawals of around 10 million ounces from Swiss and UK inventories between 2007 and 2016. While we do not believe this above ground stock has been exhausted, no market can support large deficits indefinitely. And what had gone on then is that they were running at that time, and they continue to run, about a 1.2, 1.3 million ounces a year deficit, where they're burning material from above ground stockpiles to meet overall demand. So you have your mine supply, you've got your recycling, which is about 6.5 million ounces. You've got your recycling supply, which in round numbers is about 2 million ounces. And then the delta between the 10 million ounce demand and the 8.5 million that you have from those two sources is met by destocking or burning up inventory. And so he was sending a signal there saying this can't go on indefinitely. And 2017, they ran the same deficit. And 2018, we're heading for about a 1.3 million ounce deficit in the same next year. And so what we've seen, I believe, is the consumption of the readily available above ground stockpile into the market. And I think that there may be another factor at play. So that's about 15% in round numbers of total demand, which appears to be drying up in terms of availability. And the other factor here, Sean, is I looked into the UK's trade statistics. The LBMA is the premier pricing and allocation vehicle for bullion, palladium bullion, globally. It is also for gold. And what I've seen from the UK trade statistics is that Russia, which produces about 2.6 million ounces a year of this material, in 2018 through October, which is the latest statistic that's available, they've only exported in round numbers about 135,000 ounces to the UK. So it may be that the stockpiles have been drawn down to a point, and it may also be that superimposed on top of that, that Russia, for strategic reasons, is exporting less of the metal, compounding the problem. And so when the metal stops to flow in any of the four precious metals, which are traded using these unallocated contracts or promissory notes, if the metal starts to flow, the users, or those who need the material, are going to start to ignore these contracts and say, you know what, we just want to take delivery of the metal. And that's where you risk a disorderly market, because the flow and the trade and the setting of the price is dependent upon the acceptance of these unallocated contracts. And you know, I sent an email to the LME, and they responded. It's a strange structure. The material is traded through the LBMA, that's the oversight organization, but they set the price twice daily on the London Metal Exchange. But the LBMA owns the data, and I do not know why they set it up like that. But the LME responded to me saying that about 95% of the daily trading in palladium was in these unallocated contracts. So that means that they're basically, and there's 5 participants in the auction process. There's 5 participants that have been historic players with the recent addition of Goldman Sachs into this. But so what they're doing is they're trading these contracts or promissory notes, and ultimately what happens is the price is only going to be set with the delivery of metal. When you have physical metal shortage, they'll start to ignore the promissory notes and just buy the actual note itself. And no one's going to sell a promissory note if they know they're going to default. So you start to have withdrawal from this market as the physical supply dries up.
Well, it's really fascinating to watch this, and it's interesting to discuss it because, you know, they've beaten silver down. Silver's been taken out to the woodshed and beaten nearly to death. And but we know it's still a precious metal that's valuable because it still gets traded. They still manipulate it daily. It's still one of the 4 precious metals over there. We have platinum, palladium, gold, silver, all traded with these unallocated paper contracts or promissory notes, as you put it. So we know silver is still important and precious and rare, but they've beaten it to the point where it feels like it's not valuable at all. I'm always stunned when I get an order from my buddies over at SD Bullion. I'll buy a few silver coins here and there. And I'm just always stunned when they show up because they're so beautiful. I hate the Queen of England, but I like her Queen's Beasts coins. They're beautiful 2-ounce coins. They're just so substantive, and the strike is so beautiful, and I know how rare that coin is, and when it shows up and I know I got it for 16 and a half bucks, it just stuns me because I know you can't pull the stuff out of the ground and mint it into a beautiful coin for that price. So how does this whole thing come to an end? I know that you believe that it's possible that palladium is going to bring down the LBMA house of cards, their unallocated paper house of cards, which includes the trade of gold, silver, platinum, and palladium. Do you think that'll really happen, or do you think they're going to get palladium under control and just continue to manipulate?
No, it's the users of the metal. 80% of the use of the metal is in catalytic converters for gasoline engines. Right. And I think we're heading for a drastic economic slowdown, but the metal supply has dried up today. And what you risk if you can't get the metal, you can't ship a car without a pollution control device on it. So the auto manufacturers are going to secure the metal that they need to stay open. But I think what happens here is that if you start to have default and disorderly trading and shutting down or suspension of trading, it advertises the fact that there's a problem, that these auto manufacturers or catalytic converter manufacturers who hold these unallocated contracts are unable to secure the metal for the contract, right? You hold the spot contract, you hold it with the understanding that it's immediate ownership, and if you submit it, that you get delivery typically within 2 days in London, and you can ship the metal and take it into your possession. So I think what's going on with palladium is that it has the smallest above ground stocks. It's been running a structured deficit for almost a decade now, and they've consumed a large part of these above ground stockpiles. And you can't play the game anymore of drilling the price with paper, because paper is not the trade anymore exclusively. That It's the availability of the metal. And so I think that what you have here is the advertisement of an issue in London, which will become increasingly apparent. Not everybody is jumping up and down about this right now, but with a cost of leasing it at 30% for a 1-month lease, we can see that there's a problem in the market. And so if you've got many times the available stockpile of metal issued in these contracts in palladium and platinum and silver and gold, then I would expect to see surging lease rates in the next smallest inventory above ground. And I think that's platinum, or it may be silver, but I suspect that it's platinum next is going to be the one where the users of the material might start to say, hey, you know, those guys in the palladium market can't get the metal. Maybe we should just submit these unallocated contracts and take a delivery. And because of the leverage, the numerous times of the available metal that's written in these unallocated contracts, you only need a percentage of them to stand for delivery to have a disruptive impact on the paper pricing mechanism that they use there in London.
Yeah, that's what I'm wondering. It seems to me that the world's filled with smart, well-heeled traders, and if they take a look at what's going on with the palladium market,
Yeah.
a lot of these guys are interested in arbitrage and finding ways to, earn money. 30% interest that's insane. That's enormous. I mean, if they could take delivery of silver and start to force the same thing in the silver market, certainly there's traders that would want to do that. I just wonder if the big international banks still yield enough power in these markets to prevent that happening with silver. I mean, look at JP Morgan's hoard of physical silver. But to your point, it could happen. I mean, it should happen.
Yeah, it takes time, Sean. And so I think that with palladium, just to give you an idea of how tight the market is, and in the COMEX in New York, they have the NYMEX, there's 10 vaults there. And in all of those vaults in the registered category, which is the metal available to market, there's 18,000 ounces of palladium. And if you look at the Tokyo Commodity Exchange, the TOCOM, they've got 600 ounces of palladium in their vaults.
What?
So yeah, it's
You're making me wish I'd never sold my 1 ounce.
Well, it is an industrial metal, so I think it's going to go much higher in the short term. I don't know ultimately where it goes if you have a rapid decline in auto purchases. But I do think there's something at play here in that, we've had a reduction in supply and continued deficits in the markets. And then I think that you start to get forward buying, which is really a crucial concept for a user of the material. I know if I was running the supply chain for a catalytic converter manufacturer, if I start seeing this action in the market, instead of buying maybe 2 months of metal at a time, I'll say, you know what, I'm going to buy 6 months or 9 months of metal supply this time. And so actually the shortage in the market really augments consumption of the material and compounds the shortage problem, sending the price much higher, which ultimately solves the problem. But for a leveraged paper market, it's kryptonite, really. So we'll see how it plays out. But I think that the palladium market is well on its way to having some kind of an event here. I would think that if we watch silver and platinum next, we'll start to see the lease rates moving up. Silver is still a negative lease rate in London. I haven't checked platinum recently, but I'm going to start tracking that very closely to see if we see a knock-on effect. And then ultimately into gold. But I think what's the issue here is that we're highlighting the problem with these unallocated contracts, paper contracts being substituted for the real thing. So we may come to the end of this virtual pricing and back to a real price discovery process which existed prior to the LBMA being created in 1987.
All right. Well, price discovery, that leads me to this final question here. You tweeted out on December 13th a chart that is really stunning. It's from Dimitri Speck. So I'm going to put that up on screen here. And you wrote, if anyone suggests using unallocated fake gold contracts to suppress metal prices at London's LBMA isn't possible, here is 2 decades of gold price data in a single graph. Think cumulative impact. Interest rates. Break that down for us. Just help us understand this graph. This represents sort of a daily way that they handle the gold trade?
Yeah, so this is an average, there's a 24-hour graph here, and it shows the net average pattern over those 20 years. And so what we see here is at the PM fix, which is the price setting point for the miners and the one that's used in the financial industry, you can see this very substantial drill down in the price, a meaningful drill down. And when you consider the fact that that over one day may not be a large percentage movement, but if you take it in the sequence of time of 200 trading days in a year, and 2,000 in a decade, and 4,000 over these 2 decades, that the real suppression of the price of metals becomes very material, in that they day after day after day applying this pattern of forcing the price down with paper ends up greatly distorting your price of gold. And so what I was saying there, I would think about cumulative impact. I was thinking, or trying to point out, pardon me, that the fact that 4,000 days of this type of drill down ends up having a material impact. And secondly, the interest rate comment there is really reflecting on the point that in 1980, they had to raise interest rates up into the 19% area in order to suppress the price of gold, or start to turn it around and get it to come back down again. And so when you have an explosive move in precious metals, you'll have investors piling back into that again and out of bonds. It's advertising a problem with the bond market ultimately. And what's that going to do to our interest rates? It's going to cause problems, as everybody that is the least bit aware of the world's financial situation, that we have the greatest debt bubble in history here. So when they lose control of this, they're going to have a bond problem as well, and we're going to have to restructure our economy and our debt markets.
This chart is really, this is something else. So
yeah.
Let's look at this chart. So you've got the arrow, you see that first slam, that's the AM price fix, and then the end of day PM price fix. That's literally where they slam this thing down almost on a daily basis, huh?
Yeah, over time, this is the pattern that has shown up as the average pattern of pricing. The price of gold, there's an interesting chart I'll send to you after this discussion, and maybe you can splice it in as a visual while we're talking here on the video. But it shows the cumulative impact that gold would actually be priced somewhere around $15,000 an ounce. And if you accounted for all the reductions in price that had gone from I believe the mid 40s in the 70s down to a couple of bucks an ounce now as a consequence of this. So if you look over time, the impact of these manipulations, if they were protracted over a long period of time, that we have a serious impact on the real price of these assets. But I think ultimately we're looking in gold prices that should be in the tens of thousands of dollars. And what they've done is really shut down the warning system, the loose monetary policy warning system, which is gold, that warns us when they print too much money, when they run too loose a monetary policy. They shut it down and then blew the biggest speculative bubble in history. And that's where we're at now. And I think it's going to be a very, very rough re-entry ride here back to reality.
Wow. I can't get over this chart because I knew it to be true. I've seen the research coming out from, Claudio Grass and so many others that I used to talk to regularly about this type of manipulation. But this is really an eye-opener, 20 years. So that AM price fix and the PM price fix, does that sort of represent the market being open in the United States timeframe? And then we see the rise of price after in the close, when the market's closed? Or just
that's the AM PM fixing. Those are the
London.
Prices that are set in London twice a day. And the PM fix is set while New York is open at the same time.
Right. Okay.
So what that price is just showing those two technical auctions that they have in London to set the twice daily price. And they're reference points for financial instruments, for banks, for miners, for anybody interested in the gold market. They're the two crucial global fixings. And so those two prices there, they systematically over those years basically worked the price down so that, it made gold a very unattractive asset, kept people in bonds even as they lowered interest rates from 19% down to 0% recently. And now they're heading back up again. The problem is that they're heading up while we've got over $240 trillion of debt now globally. And that doesn't portend a very happy time ahead.
Well, it's just so ironic. I mean, it's just the way this whole world works, right? The FDA is run by people that really don't care about your health. And the people that fix the price of gold are essentially the bank robbers. The bank robbers are in charge of the banks. And it's just, we're all so sick of this crap. We're also sick of the corruption, the endless oodles of corruption that we see around the globe. And, I don't wish the day the dollar dies. I don't wish it because I like our lifestyle in this country. We're all very blessed, but I think this is going to end very, very badly if they ever lose control. And it's going to be a global meltdown. It's not just the US dollar. It's the euro. It's the yen. It's the yuan. It's going to be a global meltdown if ever they lose control of this and gold goes to where it should be priced and silver goes to where it should be priced. It's going to be a global problem.
Well, yeah, we're going to have to restructure the bond market. It has to be there. We have to go through a restructuring. Donald Trump has been through many debt restructurings, running the real estate company that he did. He knows the game the banks play, and they probably don't appreciate him very much. And we're going to have to issue a new currency. It's going to have to be something that gives people confidence. And I don't think it's going to be coded digits like Bitcoin. I think that ultimately we're heading back into a sound monetary system. It may take a decade or it might take a few months. I don't know. But, kicking and screaming, the system is going to be dragged through a restructuring, despite the fact that those who benefit from these speculative bubbles and the blow-offs and the concept of central banking of, heads I win and tails you bail me out, which is really how the banks have operated ever since the Federal Reserve has been created. They always knew they could run loose monetary policy, that the banks would benefit greatly. And then when things went sideways, they would just print money and bail out the shareholder banks of the Federal Reserve. So the system is coming to an end. There's too much visibility with the internet, and it's unsustainable. We can see that lifestyles are declining, and we're starting to see riots across Europe. The cost of living is increasing. Standards of living are decreasing, and people aren't happy. It's not all about a carbon tax. There's many different things happening. But people are, I think, well and truly tired of the injustice and the decline of their life with the current globalist system and with the current use of central banking that degrades their quality of the life they live.
One last thing here before I let you go. I know that you follow politics very closely. And since you mentioned the Fed there, our central bank, the international banking-owned private Federal Reserve, the private entity that controls interest rates and manipulates our economy and has done so since 1913. Have you been following President Trump's tweets about the Federal Reserve? Basically, he's been saying that it's his biggest stumbling block or the biggest enemy to his agenda is the Federal Reserve. And he has been very vocal taking on the Fed. And we have not seen that from presidents in the past. Most presidents play ball with the Fed, and show so much respect for the Fed and the Fed chairman. But President Trump is willing to take these guys on at his own peril.
Well, I think he has to. I think that there's something called the true money supply, which is an Austrian measure. You can look it up. It's TMS-2. So true money supply -2. It's a broad measure, and it measures the checkable deposits that are in U.S. accounts with no holds on them. And what we see there is that the Fed has tightened now down to about a 5% growth rate year over year. It has been as high as 20% on a year-over-year level, which is really quite incredible over the last decade. Pardon me. But we see that we're now tightened to a growth rate in the 5%, the sub 5% range, which was enough to trigger the dot-com bubble bursting in 2000, and which was enough to trigger the financial crisis in 2008 and the housing bubble popping in 2008. So they've tightened into that range now, and typically when they've hit this range, it's within the next 12 to 18 months that you have some kind of a financial crisis. And so we're already tight enough now that I think we're guaranteed to have an event. It's just a matter we're waiting for the bang. But I think it's inevitable now that they've tightened to the point now where something's going to happen. The economy has, and the financial system has momentum, and for these things to manifest themselves takes time. But I think that President Trump is well aware that there's an economic event cooked into the books here. And I don't think that if Powell stops here, or even if he starts to lower rates, I don't think it's enough to prevent what we have coming because of the knock-on effect over years of this tight money. It's not something that you turn around, do a U-turn. overnight and solve the problem. So it's a credit economy, and they're tightening credit. It's a credit bubble, actually, and they're tightening credit. And I think Peter Schiff said you can't taper a bubble, and I agree with that.
Well, President Trump needs to restructure the Fed, and that'll be the battle of his lifetime, because it'll be amusing if that ever happens to see how the Mockingbird mainstream media reacts, and would probably try to hang President Trump in the court of public opinion, because, of course, the mainstream media would run to the Fed's aid, because a president should never meddle in the affairs of the privately run Fed. They know what's best for the American people and for the world. No, they know what's best for the Rothschilds and their private owners. So, all right. Well, David, explain to people how they can find you. I know when I spell your name wrong on Twitter, I can't find you. So let's spell your name correctly so people can find you on Twitter and safehaven.com, etc.
Yeah, I post most of my thoughts. I try to keep up with what's going on in the leasing market right now, because I think it's a true measure of stress in the palladium market and the other metals as well. So I post on Twitter under the name Real David Jensen, and that's Jensen. So no spaces, Real David Jensen, and they can follow the things there. I've historically been posting my articles right back to my letters to David Dodge, who was the governor of the Bank of Canada. I sent him 2 letters in 2007. I met him here in Vancouver after a speech and warned him that we were heading into a crisis. So I've posted the articles since then on that website as well. So safehaven.com, there's some of the articles, including some palladium market analysis I've done as well, Sean.
All right. Well, thanks for reaching out. I really appreciate you emailing me again. We haven't spoken in far too long. And, the precious metals is still very important to me and my listeners, because we know what's going on in terms of the overprinting of currency across the planet. And I think if you own physical silver and physical gold, you will be rewarded one day, that's for sure. And certainly if there's a dollar crisis, you'll be greatly rewarded for having the prescience of having purchased and taken delivery of physical silver and gold. So do me a favor, David, if you see any of these lease interest rates start to skyrocket in silver or gold, let's get you back on to talk about that.
That sounds good.
All right. And thanks for joining us. I appreciate your time.
My pleasure.
All right. And guys, thank you so much for tuning in. You know how much we love you guys. A shout out to my patrons over at patreon.com. You're keeping us in the fight as CNN pays Anderson Cooper $12 million a year to spew lies globally. We really do appreciate your support. And thanks for liking this video and spreading it within your sphere of influence on social media. And for real news 24/7, visit us at sgtreport.com. God bless.
You're going to see arrests, and then you're going to see indictments, and then you're going to see convictions. They are scared to death.